Hey everyone, welcome back. It's Finance Friday, another special edition of Money Girl, where I answer your burning money questions. Today we have a great topic. It came from Emily G., who says, I'm 28 with an annual income of $47,000 and no debt. I just inherited a little over $200,000 from my father, who recently passed away. It came from selling his property, which I owned for less than a year. How will that affect my taxes and any capital gains? Also, what are your recommendations for managing my inheritance? I've been told to invest in multiple CDs, but I'm uncertain about what to do with it. I appreciate your questions, Emily, and I'm so sorry to hear about your father's passing. This podcast will review how an inheritance may get taxed. Knowing the rules for you or your beneficiaries can help with estate planning and minimizing taxes. Plus, we'll review how to make the most of an inheritance based on your situation and financial goals. Thanks for downloading episode 891 of the Money Girl podcast. I'm Laura Adams, an award-winning author, money speaker, on-camera spokesperson, and consumer advocate. I've been hosting this show since 2008. You can learn more about me at lauradadams.com, and that's where you can contact me about PR and marketing work or speaking appearances. You can also sign up for my free Substack newsletter called The Money Stack. It gives subscribers a terrific free money success toolkit, which is a great way to start the year. If you have a question about money, you can use my contact page at lauradadams.com or leave a message 24/7 at 302-364-0308. So let's get into this important topic. If a family member or friend leaves you an inheritance, you may be like Emily, wondering if you owe taxes. Well, the answer depends on factors like the tax laws in your state, what you inherited, the inheritance value, and your relationship with the deceased person. So before we get into all that, I want to take a step back and first review what happens to your belongings when you die. I know this is a tough topic, but it's something we're all going to have to deal with eventually. So the total value of your assets, things like your cash, investments, real estate, vehicles, collectibles, and all your personal possessions, all of that collectively is known as your estate. Now, while the word estate sounds like something only for wealthy people, estates can be large, estates can be small, and they don't even necessarily need to include land. We kind of think of an estate as a big piece of property, but that's not the case. Your estate is simply what you own at your death, and since it must pay off your debts, it's equivalent to your net worth. It's your assets minus your liabilities at the time of your death. Now, every adult should have a will that names an executor to manage their final wishes and the estate's financial affairs. Your executor is responsible for things like paying applicable estate taxes and liabilities, and then distributing any remaining assets to your beneficiaries. Your executor can be a professional, like an attorney or an accountant. It could be a family member or friend, even if they're also a beneficiary named in your will. But if you don't have a will or you don't name an executor, a court will appoint an executor for you, and that person may not resolve your estate the way you'd like. So if you don't have a will, I want you to make creating one and naming an executor a top priority this year. Also, if you have minor children or other dependents, you should also name a guardian in your will who would physically and financially care for them if you died. When your estate gets settled through the legal process known as probate, it may owe an estate tax, and that would range somewhere in the neighborhood of 18% all the way up to 40%. However, that hefty tax only applies to estates valued over $13.61 million in 2024, and that estate tax threshold will increase to $13.99 million in 2025. In addition, 13 states impose various estate taxes. For instance, in Oregon, estates over $1 million get taxed from 10 to 16%. In Connecticut, amounts over 13.61 million get taxed at 12%. So the federal and state estate taxes typically only apply to high net worth decedents unless Congress lowers the exemption in the future. Therefore, if you have significant assets, you want to be sure to work with an estate planner to minimize taxes and preserve wealth for your heirs. Once an executor distributes your available estate assets, different taxes may apply for each beneficiary. Emily may be glad to know that the federal government does not consider most inheritances taxable income. In other words, you don't have to pay ordinary or capital gains taxes if you receive cash, stocks, mutual funds, real estate, vehicles, collectibles, or any valuable personal property. However, as of 2024, there are 6 states that do impose a state inheritance tax. They are Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. But even if you live in one of those states, you may be exempt from paying tax on some or all of an inheritance. For example, inherited amounts over $100,000 get taxed from 0 to 15% in Nebraska. Iowa has no exemption but imposes a tax from 0 to 2%. Plus, in most states, you don't owe tax when you inherit property from a deceased spouse. So be sure you understand the inheritance rules in your state so you can reduce your taxes. Emily didn't mention where she lives. So Emily, be aware that there may be some state issues at play just depending on where you are. In addition, certain assets and untaxed income that would have been taxed as ordinary income to the decedent are taxable. It's called income in respect of a decedent, or IRD, and it may include things like their uncollected salary, pension income, and traditional retirement accounts. And I'm going to talk more about inheriting retirement accounts in a moment. If you're the beneficiary of someone's life insurance policy, be aware that the proceeds are generally not subject to income or inheritance taxes. Since those funds are not part of the deceased person's estate, the funds don't go through probate and they get paid directly to the policy's beneficiaries. Since a typical inheritance is not subject to federal taxes, it doesn't need to be reported on your tax return. But as I mentioned, there are 6 states where you may need to declare it. In addition, any earnings you receive from inherited assets must be reported as taxable income on your federal and any applicable state income tax return. For example, earning interest on an inherited cash account or earning rent from an investment property would be taxable. So to sum up, an estate tax is levied against the taxable estate of a deceased person by the federal government and 13 states. An inheritance tax is levied against individuals who receive an inheritance, but only in the 6 states I mentioned, and the taxable amount varies significantly from state to state. I'll put a link to a great resource in the show notes. It's a complete list of estate and inheritance taxes by state. Now, I want to talk about something called a step up in basis. This is a really favorable tax provision that most beneficiaries are going to benefit from because it reduces capital gains tax when you sell an inherited asset. Capital gains are calculated on the difference between an asset's selling price and its cost basis, or its original purchase price. When you inherit an asset, its basis gets adjusted or stepped up or even down to its fair market value on the date of the previous owner's death. That resets the cost basis of any appreciated inherited asset for tax purposes, and that typically reduces or even eliminates capital gains taxes when the new owner sells it. Let's say the property Emily inherited was purchased for $50,000 many years ago, and it appraised for $200,000 when her father died. A few months later, she inherited the property and sold it for $200,000. In that case, Emily would owe no inheritance taxes on the property or capital gains taxes for selling it. However, if the property Emily inherited was worth less when her father died and she sold it for a profit, then she would have a taxable capital gain. For instance, if the fair market value or stepped up basis was $175,000 and then Emily sold the property for $200,000, she would have a $25,000 taxable capital gain. Emily mentioned owning the property for less than a year, which would make any potential gains subject to the short-term capital gains tax, which is the same as ordinary income tax rates. They range from 10% up to 37%, depending on your income and tax filing status. So any capital gain would be added to Emily's total taxable income for the year. Selling an asset for a profit after owning it for more than a year means you owe long-term capital gains tax. That is much more favorable because it ranges from 0 just up to 20%. That means you get much better tax treatment when you own an asset or an investment longer than a year before selling it, especially if you're a high earner. So Emily may owe short-term capital gains tax, which is again the same as her ordinary tax rate, if she sold her inherited property for a gain exceeding its stepped-up basis. Emily, if you're unsure about the basis of the inherited property or how to calculate a capital gain, definitely consult with a certified tax professional. Now, there are some exceptions or limitations of this favorable step-up tax treatment for heirs. One is when you own an asset jointly with the deceased. In that case, you only get a step-up on their portion of appreciation at the time of their death, but you don't get a step-up on your portion. For instance, if you own a home 50-50 with a parent, and they pass away, only half of the basis would get adjusted to its fair market value at the time of their death. Your half would remain equal to the property's original basis for tax purposes when you go and sell the property. When you own real estate as a married couple with rights of survivorship, the surviving spouse automatically inherits the deceased spouse's share and gets a step up for half of the appreciated value at the time of their death. However, let's say you live in one of 9 community property states. They are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. And you are a surviving spouse. Well, in that case, you actually receive a stepped-up basis for both ownership portions or the full amount of the community property. Again, you need to speak with a qualified tax professional if you've got questions about the value and tax liability of an inheritance. I also want to mention the gift tax because this is very closely related to the estate tax. I want to note that if someone gives you an asset while they're alive, instead of leaving it to you after they die, the asset will not qualify for a stepped-up basis. However, transferring high-value property to loved ones or charities during your lifetime could reduce future estate taxes and provide financial support sooner rather than later. So I'm not saying that, gifting isn't a good thing. If you give away money or assets, you can give an amount annually without reducing your lifetime estate tax exemption. Remember I said that's going to be $13.99 million for 2025. You can give away up to $19,000 per person without needing to file a gift tax return. That's starting in 2025. And the gift tax return is IRS Form 709. I'll put a link to that in the show notes. The gift tax return allows the IRS to keep up with your lifetime estate tax exclusion because the amounts you give away over the annual exemption per person will reduce the size of your estate when you die. So as I mentioned, this isn't going to affect most people because most people don't have an estate worth, almost $14 million. But if you do, this is something that you need to plan for. Now, I mentioned that inheriting a retirement account is a little different than what we've been talking about here. If you inherit a retirement account like a traditional or a Roth individual retirement account or IRA, there is never a step up in basis. Tax advantage retirement accounts don't get any adjustment when you inherit them, but they have to be included as income when you take required withdrawals. So let's say your spouse dies and you inherit their IRA. In that case, you can transfer it into your own IRA or even into a new inherited IRA account. But if you inherit an IRA from someone who wasn't your spouse, like a parent, sibling, or friend, you have to empty the account within 10 years and pay all applicable federal and state income taxes. And depending on the IRA value, that could significantly increase your taxable income over the next decade. Now, if you've got a pre-tax traditional IRA, you must take taxable annual required minimum distributions or RMDs starting at age 73. So that's going to be the case even for a spouse's IRA that you inherit. You've got to start those RMDs at age 73. However, there are no RMDs when you inherit an after-tax Roth account. And, that's the case whether you're inheriting it from a spouse or a non-spouse. If you inherit a retirement account and the deceased previous owner had not started taking RMDs, in that case, you are not obligated to make a distribution from the inherited IRA every year. So you can be strategic and stay in the lowest tax bracket possible over the 10-year withdrawal period. For instance, if you have a low income year, you might decide to empty the inherited IRA instead of spreading out withdrawals over multiple years. You can do whatever will benefit you from a tax perspective. While you must empty an inherited Roth account within 10 years, you always enjoy tax-free withdrawals. Okay, Emily also asked about the best way to manage a $200,000 inheritance. Whenever you experience a significant life event, like the loss of a close family member or receiving a considerable windfall, take the time to review your finances, set new priorities, and if needed, meet with a financial advisor. If you have not listened to podcast number 785 called 6 Smart Steps for Managing a Cash Windfall, that's a good place to start, but I'm going to summarize the show here. So we'll go through the 6 steps. Number 1 is to identify the purpose of your money. So this is the first step for successfully managing any windfall. It's just to identify its purpose. For instance, do you need it for short-term expenses, like buying a car or paying down high-interest debt? Or should it be set aside for your long-term goals, like buying a home or retiring? The second step is to review your financial safety nets. Now, Emily is in a great position because she has no debt, but she didn't mention having any savings. If she doesn't have an FDIC-insured savings with at least 3 to 6 months of her living expenses sitting in that account, that's where some of her inheritance should go. Emergency money is essential for managing unexpected expenses and hardships like losing your job, making home repairs, or paying medical bills. Plus, a healthy emergency fund can be the ticket for staying out of debt when surprise bills pop up. And Emily, you don't want to invest your emergency fund. You always want to keep it liquid in a high-yield FDIC-insured bank or money market account. The third step is to put your retirement on autopilot. Emily didn't mention having investments like a workplace retirement account or an IRA. So I recommend that she max out a Roth IRA by contributing $7,000 for 2024. You've got until your tax filing deadline to make IRA contributions for the previous year. Now, the deadline to contribute to a workplace retirement plan like a 401k or 403b is December 31st. And if Emily has one of these accounts at work, she could set up automatic Roth contributions to max out the account by the end of 2025. And she can put in a total of $23,500. That comes out to about $900 every other week. So depending on how she gets paid, whether it's every other week or bi-monthly or monthly, she can work work that out. So by the end of the year, you have maxed out the account. She could also automate contributions to a Roth IRA by contributing about $270 every other week so that by the end of the year, she's contributed the maximum of $7,000. The fourth step in managing a windfall is to create a diversified portfolio. So if Emily's IRA or workplace retirement account is with a well-known investing firm or a robo-investing platform, there will be no shortage of excellent investment choices like mutual funds, index funds that will give you a diversified portfolio. And the purpose of diversifying is that it allows you to earn higher average returns while reducing risk. If some securities within a fund lose value, some are going to hold steady or even increase in value, minimizing your potential losses. The fifth step is to consider your risk tolerance. While the stock market can be volatile, its historical average return has been about 10% since the 1920s. So if you're like Emily and you're decades away from retirement with plenty of time to recover from temporary market downturns, most of your portfolio should be in stock funds. That could be an index fund, an exchange-traded fund, or a mutual fund that is primarily comprised of stocks. Emily asked about putting her money in CDs, which could be an option for a portion of her cash after funding a liquid high-yield savings account and maxing out available retirement account options. However, she can earn higher returns by investing some or all of her remaining money in a diversified index fund using a brokerage or a robo-advisor. So, Emily, that's what I would recommend. I mean, if you wanted to put some amount of your remaining money in CDs, just be aware that's very conservative. You're going to get a lower return than you could investing. And the idea is that you're going to keep liquid money in your emergency fund for, any hardships that may come up. All right, and the sixth step is to get investment advice when you need it. Getting a significant windfall like a gift or inheritance is a fantastic opportunity to improve your finances that you shouldn't squander. If you're unsure how to manage it or to choose investments, please get advice from a certified financial professional or a tax accountant or a retirement planner. All of those professionals can really help guide you in the best way. Emily, I hope this show has been helpful. Again, I'm so sorry to hear about your father, but I know that you're going to put this inheritance to good use, and I think your question will help a lot of other people who are listening. Maybe they have inheritances that are smaller, but, the same principles and ideas will apply. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we have a terrific team. I really want to thank Steve Rickyberg. He audio engineers the show. Brandon Gaetjes is our director of podcast. Holly Hutchins is our digital operations specialist. Morgan Christensen is our advertising operations specialist. Davina Tomlin is our marketing and publicity associate. And Nathaniel Hoops is our marketing contractor.